Good morning, ladies and gentlemen, and welcome to the first meeting of Babergh and Mid-Suffolk Joint Scrutiny Committee. I have a few bits of housekeeping to deal with first of all. There's some domestic arrangements. Toilets are outside the meeting room opposite the stairs. Cold water is available in the breakout area, also where you came in. If the fire alarm should sound, you leave the meeting room following the fire exit signs, meet on the Ipswich Town Football Club training pitch. Don't use the atrium steps under any account. Don't re-enter the building until you're told it's safe to do so. Could members turn off their mobile phones or at least turn them to silent? I personally would prefer if they were turned off. I must admit I haven't done mine. I'd like to remind everybody that the meeting will be broadcast live on the internet and will be capable of repeated viewing. The whole of the meeting will be filmed, except where there are confidential and or exempt items, and that is the case, or likely to be the case in this meeting. If you're attending this meeting in person, you're deemed to have consented to being filmed, and that the images and sound recordings could be used for webcasting and or what's described as training purposes, which is always a little worrying. This call is being recorded for training purposes. If the only other thing is anybody can record, film, photograph or broadcast at the meeting except where the public are excluded because it's a matter of commercial confidentiality. And finally, can you check you've got your microphone on and turn it off when you've finished? And I'm the worst offender myself, so I apologise in advance. Okay, first item on the agenda is apologies and substitutes.
There are no apologies, Chair.
Declaration of interests? No. To receive notification of petitions in accordance with the Council's petition scheme, item 3.
None received.
Got it. Questions by the public, item 4.
None received.
And 5, questions by councillors.
None received, Chair.
Thank you very much. So we come to the substantive item of today's meeting, which is report JOS 19-1, Capital Investment Fund Company, CIFCO Capital Limited, Business Trading and Performance Report 2018-19, and fundamentally the business plan for the successive year. Before we start on the item and receive reports, and you'll have your opportunity to question, just like to advise people that discussing the principle and necessity and the original origins of the setup of CIFCO itself is not the subject of this meeting or the agenda item. And the borrowing of any monies that agreed, say, in February 2019 is also not the subject under discussion. We are looking at the business plan. So at this point, I'd like to hand on to either the Cabinet member responsible for assets and investments at Babergh, Dave Busby, or Emily Attack, who is the Chief Executive of CIFCO and Managing Director, my apologies. So many titles, and there's also our Assistant Director for the same portfolio. I'll leave it to you two.
Good afternoon. We're here today to talk about the CIFCO business plan. We have a panel of experts who are both board members and our professional advisors. So I'll start by introducing who everyone is here, and then I'll pass on to Chris, who will then take us through a presentation which we will all contribute to. So to my right, this is Chris Howarth. He's the chairman of the board of CIFCO. Mark Sargentson to my left, he's a board member of CIFCO. Both Chris, Mark and I are chartered surveyors. And then we also have Jones Lang LaSalle with us today. Jones Lang LaSalle are our principal property advisors, both from an acquisition point of view and also from a fund management point of view. So we've got Neville Pritchard and Nigel Golder here today as well. So we have I'm hoping a relatively brief presentation to take you through, which hopefully will take you through the sort of key aspects of the business plan. There is a small section at the end which will need to go into the closed agenda, but we're happy to take questions before we get to that point. Obviously, if there are questions that really stray into the closed section, it would be more sensible to have those questions at the end of that section. So if that's okay, I'll pass you over to Chris, if we could get the presentation up on the screen.
Thank you, Emily. Yes, we're here to talk about the CIFCO business plan. We're well into our into the business of the company. So first of all, just to look in summary at the portfolio that we've acquired so far. The total asset value is now just over 50 million, with a rent roll of just over 3 million, 3.133 million. The estimated rental value of that before reviews and everything took place shows a rent roll of just over 3.3 million. The portfolio is it's comprised of 12 assets. There are 34 tenants, so you can see there are some properties obviously which are multi-let. The weighted average unexpired lease term across the portfolio to break, because obviously some of the leases within the portfolio have break clauses. So 7 years and 7 months, and the WALT to expiry is 8 years, 11 months. So you can see it's a pretty secure portfolio. The initial yield on acquisition is 5.75%. The equivalent yield is just a smidgen under 6%. And the reversionary yield, taking into account the various rent reviews and everything else, is 6%. You can see also finally the void rate at 0.3%. I mean, there are a number of assets which we've acquired which have quite a lot of tenants, and actually there is an advantage in having a little bit of a turnover of tenants. We can talk about those later, because it's a good way of proving rent, showing rent increases, building up the rent, and helping to manage the portfolio. So we then move on. So obviously what we're talking about today is the business plan, and it has a number of important functions for us as a board. First of all, it monitors the performance of CIFCO Capital over the previous financial year. You can look and see what we set as our KPIs, how well we've met those, and what's happened. Secondly, it also sets out a framework and guidance for investment. Obviously, we're operating in a market where things change, and so it's very important that we are fleet of foot in how we invest the funds. But it's also very helpful for us to set out early on a framework within which we invest those funds. And obviously, and Jones Lang will talk about that more shortly, but obviously they're a very important part of the setup, having Jones Lang as our investment advisors. The business plan also forms part of the company's governance, extremely important to the board, the governance, looking at risk and everything like that. It's something we focus on at all board meetings, so it's an important part. And finally, of course, it gives something for the directors to be accountable against the delivery of the business plan. Again, something that as directors we're certainly very focused on. So, the key business plan functions for 1920, and what has really changed is that as the board was first met in June 2017, and we were very much charged with going out to acquire the portfolio, which we have done. We've done that, so that now means that a very important function of what we're doing is the management and enhancement of the performance of the existing portfolio. So that's a big part of what we do. Again, working with Jones Lang and our professional advisors, looking at how we improve the value. We may decide that we've owned an asset, we've maximized value. We may actually decide to sell something at some stage in the future. And it's absolutely vital that we monitor how we go forward, how we use our properties going forward and make sure we enhance the value. And then, of course, the other important role of the board is the investment of the further tranche of funding of 50 million, which we're very pleased the councils have entrusted us with doing that. So that will be the other part of what we have to do as a board. And we, as part of our board meetings, we do keep those functions separate so that we can focus on them both. Then moving on, it's looking at the key performance indicators for 18-19. So this is looking back. You see, we set ourselves a net initial yield performance against target of 6%. The actual initial yield was 5.75%, so a little bit below that. And I think that was probably really a function of the market as part of what we set ourselves at the beginning of the previous business plan was to try and acquire some slightly more risky, with a small section of slightly more risky properties where there's more chance of added value. We found it difficult to find any of those at the right, what we felt was the right sort of figure, and therefore we didn't acquire any. And what that meant is that we've ended up with probably a more secure property portfolio, but it means the yield is just a little bit below probably where we would have been if we had had one or two of those assets which were more what we call opportunistic. So you can see his initial yield of 5.75% with an equivalent yield of just a smidgen under 6%. The second KPI was the fact that we were looking to invest the full amount of the funds within 18 months of setup, which had been by January 2019. We missed that slightly. It was fully invested by March 2019. And so that was, in doing that investment, we look at an enormous number of properties, 70 or 80 a year, I would have thought at least. We make offers on a few of them. And as you can see, out of all those offers we've made, all the properties we've looked at, we've ended up acquiring 12. So we look at a lot of stuff before we find what we think is the right property to form this portfolio. And then KPI 3, the distribution performance against target. We set ourselves the target of raising interest rates payable to the council from 5% to 5.25% by September 2019. I think that because we are now in a further phase of acquisition, I think we are unlikely to be able to do that. It's certainly something that we are focused on to raise the amount of funds that the council get. And Emily will talk later on in this presentation about what will be coming to the councils. I think we're unlikely to be able to do it in September 2019 because we're going to be continuing to acquire. But it's something that very much we have in mind as a focus as we move forward. And just quickly, my last part really, you can see up here the 6 properties that we have acquired during the period of the last business plan. Eastman Way, Hemel Hempstead, which is an industrial building in the Maylands Business Park in Hemel Hempstead. Very, very good location. Rent review coming up in a few years' time, so the chance to improve the rent. Good covenant, so a good, solid core asset there. We then acquired Olympus Close, which is a little industrial scheme, number of smaller units, total of 21,800 square feet. And this is a classic one that I was talking about before, about where there's an opportunity to move on rents. We'll have a number of vacancies here, but that's absolutely normal. We expect that. It's a good opportunity to move rents forward and gradually build the value of the asset. Moving on to the next one, which was Southampton. I think, as you probably know, the focus of the portfolio was to be within the eastern region, but with the ability to look outside the eastern region. As we were building the portfolio, we bid on a number of office assets unsuccessfully. And so as part of the diversity of the portfolio, in other words, so that we can spread its risk, we were very keen to get an office asset. And this one came up in Southampton, which being, well, although it was outside the area, was one which we felt was a very good asset, a good, solid asset, 17,000 square foot office building, recently removed break options, so it was a good, solid asset for the portfolio, so that was why we acquired that. We then also acquired the Omron building in Milton Keynes, which was another office building of just over 22,000 square feet. Again, a good, solid office asset for the portfolio. We then acquired Lutia House in Brentwood. Again, another office asset. And then finally, DW Fitness in Lincoln, which is it's one of the alternatives. It's German fitness. Again, an excellent asset with a good long lease and about 19,000 square feet. Let off a low base rent with fixed rental uplifts. a good basic asset for the portfolio to show some good growth in the future years. So that's really all I've got to say. I'd like now to pass over to Nigel and Neville to just take us through the talk of the market and where we stand on the portfolio.
Thank you, Chris. Good afternoon, everybody. Just to set matters in context, a little bit about where the market has been over the last year or so. 2018 was a strong market for investment property, and the turnover in the UK was 65 billion of transactions. The norm is something in the order of 50, so that gives you an idea of how strong the market was last year, in a good way, because people wanted to buy investment property, and the returns have been very good. Coming on from there, I hate to use the word Brexit, but we can't not mention it. Early this year, certainly the first quarter, in the run-up to thinking something was going to happen, then there was a little bit of people sitting on hands, not quite sure what was going to happen, and there were transactions happening, but that has speeded up, and we're actually in a fairly active period at the moment. I think realistically, we can probably say that towards the end of the year, depending on what happens, then it could become a little quiet again, but we'll just have to play it by ear a little bit and see what happens. But overall, the fundamentals are still very strong. We're still seeing a situation where, in general, in the property markets, there is a good occupier demand and a limited supply of stock, the one major exception being the retail sector. We'll come on to that in a minute. Industrial properties are the ones which are performing best, and over 2019 we're expecting total returns to be about 7.9%. Why? The reasons are fairly straightforward. It is the lowest value property use, so you see a lot of industrial estates disappearing as there's houses built on them, or offices, or retail warehouses, or whatever it might be, and so quite a lot of the traditional industrial estates become lost to other uses, so the supply goes down. Equally, the demand has been very strong. There's a lot of small businesses which are very active at the moment, which is good. There's a lot of the last mile distribution where a lot of e-commerce companies are taking small units and distributing all of their stock from these locations rather than the retail use. So that is performing very well. And the funny thing is there's been very little new stock built, partly because finding suitable land is difficult, and partly because a lot of developers have found it easier to build very large distribution buildings than smaller mid-sized buildings, which are the sort of things we've invested in here. The office sector has performed fairly well. Its total returns this year producing about 4.2%, we believe. That figure is slightly skewed by the fact that London is finding life a little bit tough at the moment, again, due to whether there be major occupiers going abroad as opposed to here. Overall, the regions are doing quite well, and we're seeing some places like Cambridge absolutely flying at the moment, and other major office occupiers still expanding very rapidly. The retail sector, we hear it on the news every day. It's a function of having too much retail space, and obviously e-commerce as well, but also the retailers have taken on a lot of debt over the years. They're finding it very hard, so there's CVAs and other issues, and so in general, and Nigel will talk about strategy later on, we're taking the view that we should be focused much more in the office, which we've got a fair amount of now, but especially the industrial sectors and the alternative sectors, things like hotels and maybe student accommodation or things of that nature. But the key thing is location, obviously. I'll only say it once, not 3 times. The quality of the property, it's got to be modern. It's got to be something that's not going to need capital expenditure on it in the near future. It's got to be something which is appealing to tenants, and that's the fundamental, really. And if you have those functions, then you can attract the good tenants, and everything we've bought, we are very careful to look at the nature of the tenants and if they're a strong company to ensure that the rent keeps coming through. And if we have those combinations together with a long lease where they're contracted in for a long time, then actually it's not quite a bond, but it is something where you're going to get contractual income for the length of that lease, and if the building is good enough, then you should be able to relet it if the tenant doesn't renew. And so those are the fundamentals we're looking for. We talk about the industrial warehouse sector. I know we're probably overdoing it a little bit, but it is quite clear that that is going to be the best performer for the next 2 or 3 years. And so we're very focused on having bought some good quality ones so far, continuing to focus on that a little bit more, and chances are, going forwards, you'll see that the proportion of the portfolio in the industrial sector will increase. Nigel.
Thank you, Neville. Good afternoon, ladies and gentlemen. My name is Nigel Gold. I'm just going to talk you through the strategy as was in 2018-2019. Then compare that to where we are with the portfolio that's been acquired to date, and then move through to the 2019-2020 strategy and show you what the difference is, where that is material. So when we looked at the original strategy in 2018-19, as Chris has said, the target net initial yield was 6%, and it's currently running at 5.75. In terms of sector, we stated that we would want no more than 25%. And when we mean by sector, we're talking traditionally about retail, office and industrial as the key 3 sectors of investment. There are lots of subsectors to that, which I will also come on to. Location, no more than 15% invested in any one town. And the reason why we do that is again, it's risk mitigation. It's trying to mitigate your risk that all eggs are not in one basket. So diversification is very important when setting up a strategy for a real estate portfolio, investment portfolio. Lot size, this is when the original 50 million was invested, 3 to 10 million, and pretty much most of the investments fall within that range, with no asset over 20% of the portfolio. The tenant diversification, we didn't want more than one tenant to represent 10% of income. Again, it's risk mitigation, so that you're not exposed to any one particular company or covenant, as we refer to them. And then development, no more than 15% of the portfolio invested in direct development at any one time. And there's 2 reasons for that. One is development's always seen as high risk, and we are investing for income. And secondly, you get a cash drag on development. So you may be sitting there having bought the land, building for 2 years with no income. So that doesn't serve the purpose behind the strategy for CIFCO to actually generate revenue. So when we looked at the, sorry, I moved that one, sorry. Hopefully someone has got good eyesight. I'll try and talk you through this, but we firstly look at risk profile for the portfolio, and originally, as we said, we were looking at 55 to 60% to be in a category called core. So when we look at investments, we have principally 3 categories. Core is the most liquid and what we deem the safest level of investment that you can have. That's reflected in its pricing. It tends to be lower yield. We then have a second category, which is core plus or value add, sometimes referred to, which will be a little bit more up the risk curve, but it will have an asset that you can create value in it. So typically the investment that we bought in Ipswich, Olympus Park, is core plus, because we can actually manipulate it and actually grow the asset because we've got the opportunity to. And then we have a final category, which is opportunistic, and this will be much higher up the risk curve. It will be something where we may add capital into to create value. And that was pretty much down at a very low percentage weighting, originally at 10%. We are currently not invested in that sector. And that's twofold. One, opportunity, and secondly, most importantly, we've moved the portfolio more towards core because of where the market's changed, rather than take the higher risk. And yet still focus on the revenue generation. I'll now take you just through the sector splits. So originally, the 2018 target showed a retail ranging between 15 to 20. Retail warehousing, which we treat as a separate category. It performs differently to high street retail, 15 to 20. Offices, again, 15 to 20. Industrial, 20 to 25, and that was predicated on the story which maintains and continues, which industrial is outperforming the rest of the sectors, and is likely to do so, as Neville said, over the next 2 to 3 years. And then alternatives, and I'll just explain what we mean by alternative. Alternative is hotels, It can be car showrooms, which we've actually invested in, and the like. So they're a different type of investment, becoming very popular with the institutional investors now as a diversifier away from the core sectors. Many alternatives have long leases, so hotels typically 25 years, and a lot of them are indexed, so the rental income can be predicted rather than your traditional open market, which the other sectors tend to fold into. So it makes a good balanced portfolio if you can have a different spread of investment criteria. So that's why we look at sector. And I'll come on to where we're going to in 2019-20 in a moment. So where we, I've got a slightly different slide here. I've done that because I'm press that one. I'm going to move that to my right hand because I'm not left-handed. To talk you through the tenant profile diversification, as you can see, we are looking at a portfolio, and this is where we are today at 2019. We've moved very strong towards core and strong covenants, which is 90% of the portfolio makeup, which is ahead of where we originally wanted to.
Just a moment, if I may. I'm just wondering if those figures up there, although they're very small, are they commercially confidential in any way?
The majority of that information relates to the turnover of those businesses, so that we will have obtained that information through public sources. The only information that is of a confidential nature is in relation to the rent, but I think in the generic terms it's okay.
Rough estimates and open source.
Yeah.
Thank you. Just so I've established that. Thank you.
Thank you. Thank you for the question. No problem at all. I know as you say, the right-hand table actually shows the main occupiers ranked by the fund percentage income that's derived from that particular occupier. And you can see the highest is currently at 13.2%. So we have a target of 10. We're not quite there. It will dilute as we buy further investments, so they will drop below the 10%. And actually, if you drop down to number 6, number 7 rather, we quickly drop down to sub 6%. And we're quite happy with that position. We don't feel that we're overexposed to any one particular tenant. The covenants are strong, from the likes of M&S through to Go Outdoors. Go Outdoors is a 5A1 covenant. So we've got a good spread of income risk, which is really important to protecting the revenue stream. And we talked about location. Our target's 15% in any one town. We are actually over that. We're 23.7% invested in Brentwood. We can dilute that to an extent, and we do, because we've actually got two different types of investments in Brentwood. One is the Marks and Spencer's, which is in the prime central position of the town, and the other is an office building, also centrally located, but a different sector. And in real estate, the interesting thing is, and probably very stark in this market at the moment, retail is performing very differently to office sector, to the industrial sector, to others. All the sectors tend to perform at slightly different points in the economic cycle, which is another reason why we look at sector spread in your diversification. Brentwood obviously will benefit from Crossrail as and when. I'm not putting a date on that because no one else is prepared to. And then in Milton Keynes, we've got two assets which are also diversified. One's an office, one's a car showroom, and they make up 15.6%. Again, these will dilute as we buy further investments. Regionally, we are looking at around about 60%. It's 59, I think, on the actual chart, within the core region, the eastern region, with the remainder in what we call the other region. All of it is still within the south. We don't have anything higher than Milton Keynes, I think. Lincoln now, yes. So Lincoln will be the highest for going north, but pretty much it's centralised or centric to the south of England. And not invested in directly in London purely because of lot size. It's difficult to enter that market on the lot size that we're looking at. So I now move through the investment strategy for 2019. And I think when we have looked at this and set this out for the CIFCO board, we've looked very carefully at the forecasts that we do in-house, but also other economic forecasts around not just the UK, but actually globally. And we can see that capital growth is still there. It's still in the real estate market, but it is slowing. And that's definitely the trend that's happening. We expect it to continue to be positive. The only sector where that isn't going to be the case is retail, until such time as we get equilibrium in that market space. And you have to be very careful when you talk about retail, because there's a very difference between the performance of high street to out of town, to the food and beverage markets, to the leisure-based retailers. So you have to be very careful as to what you mean. And also shopping centres is another area. We can't invest in shopping centres because we just don't have the lot size. Actually, we wouldn't anyway, because that's the one sector that's dropping quickest in value. And it's probably the one area that's most distressed and probably making most of the public news. Along with some of the bigger retailers, some of which are household names, which are taking CBAs, and Arcadia being probably the largest and latest. We're looking to continue to diversify the asset profile. Because we are moving from 50 towards the 100 million invested, we can now look more towards the subsector markets. And by subsector, I'll take the example of retail. We can start to look towards supermarkets, and we wouldn't be the big supermarkets, they'd be looking at the local. We're looking at trade operators, drive-ins, that type of sector, which is a subsector of what we would call retail or retail industrial in the trade market. We're looking to diversify income risk through multi-let properties, so not all single-let. Where we have multi-let, you have an immediate diversification within that asset. So if you've got 5 tenants in a building rather than 1, you've diversified by 1/5 effectively on that income stream that comes out of that one asset. Industrial's really good for, industrial's very good for that. Offices does work as well. Obviously retail's much more harder to do because we'd be in single let, but we're moving away from retail generally anyway. We want to avoid what we call highly reversionary assets, and I'll just explain what that means. When we buy an asset, we look at the investment and its initial return, and the target is 6%. Some assets, that might be the current rent being payable, but not necessarily the market rent, and the market rent may be higher. So where the market rent's actually higher, we're not actually tapping into that immediately. We call the asset reversionary, which means in the future you will get a higher income. The problem with the market where it is today is that if we start buying more highly, and I mean highly as in significant reversions, you're actually effectively buying that risk. So what we're trying to do here is actually buy direct income and not buy too much in terms of future growth, predicted growth, that is. Investment in core towns and cities. Again, it goes back to the fundamentals which Neville mentioned, which is location. We're looking very much at prime or very strong locations. The fundamentals of good asset, good right place with the right credentials for being re-let is really important, as well as the fabric. So we make sure that we're looking at assets that are not or won't require significant capital expenditure, because again that pulls away from the investment criteria we're looking for. We're also looking towards favouring investments with good residual values. Residual can be any type. It can be commercial use, alternative commercial use, or in many cases residential. So while we may be buying an asset that's currently let as an office building and it's secure for the next 10 to 15 years, we will now, well we do, but we will look more towards make sure that we've got investments that have got residual values underneath them. Again, it protects your investment. We continue to seek long-term security with strong covenants, and we're looking towards RPI or CPI-based investments so we've got more predictable income streams. And I suppose the most important thing, given where we are in the market today, and that is to wait for the right opportunity. There is no pressure or desperation to invest. We have to wait for the right opportunity that fits CIFCO criteria and ultimately the goals that are required to generate revenue and a sustainable revenue stream at that. So lastly, I'll move on to the sector targets, and I'll cover this briefly because I've touched on it already. The sector weightings have changed. We have moved them out slightly, and the table below, actually, the final column, shows you whether we are looking to decrease or increase the exposure to that particular group. So from a retail perspective, we are invested, and we're quite happy with the retail investments we have, but we're not looking to put more money into retail at this time. So naturally, by dilution, i.e. spending more on putting more assets into the portfolio, it will decrease the weighting. Retail warehousing, we're pretty much stuck where we want to be, which is mid-range between our 15 to 20%. Offices, we're currently overweight, but we're quite happy with that overweight position, and as we invest further, again, that will naturally decrease. We're looking to expand and put more money into the industrial sector, again, at the right price. We're quite comfortable with the weighting that we have at the moment, but we're looking to increase that exposure. And then alternatives, we're definitely looking to move more into the alternative sector. We have looked at a few Travelodge and other hotel investments. We've not found anything that we think are sufficiently sustainable at this point, but we are looking at that sector. Again, generates long-term income and secure revenue streams. So that's where we are in terms of the 2018-2019 strategy, and moving through to the 2019-2020 strategy. So I'd just like to pass you over to Emily, who wants to talk through some financial matters. Thank you.
Thank you. I'll just move on. So this slide really looks at the council and the capital that is lent to CIFCO. So as originally agreed, there was a budget of £50 million for CIFCO's first phase of funding, 25 million from each council. This slide effectively shows each council and the movement of that capital through. So to date, each council has borrowed 27.26 million and made loans of just over 24.5 million pounds to CIFCO, and CIFCO has repaid a small element of the capital there as well. Moving on to the next slide, this is more about the income that the council has benefited from CIFCO. So in effect, it shows that each council has broadly benefited from £1 million of net income from CIFCO since 2017. So as you'll see from the slides, Babergh, due to their borrowing strategy, has a slightly higher number, whereas Mid-Suffolk has just below the £1 million. That's on a year-to-date basis, so that includes 1 quarter of 2019-20. We are expecting a full year to generate approximately £1.5 million across the two councils, and that's the net income for the councils moving forward. We have a further tranche of funding to be invested, so a further 50 million, and we are expecting there to be a further this to raise income to about 1.2 million pounds for the councils moving forward per council, and that's the net figure. So moving on, we will move into closed session shortly. However, before we do so, if there are any questions that you would like to ask in relation to the slides or topics that we've discussed to date, then please, we're happy to take questions.
Okay, Councillor Grandon.
Thank you, Chairman. It's really with regard to the high street retail aspect. I presume you're probably expecting questions on that. I was a bit surprised that you're looking at that area anyway, and you've gone beyond your target. And with one of our main investments being Marks and Spencer's, and we know that they're undergoing difficulties at the moment, and could well be asking for organisations such as ours for rent reductions. How will you be looking at that, and how will it affect us as an investor, please?
When we acquired the Marks & Spencers, there was a lot of research went into it at the outset. We do know that it's the third best performing store in its size range within the whole of the Marks & Spencer portfolio. It's very food orientated. It's one of those which has the whole of the lower level dedicated to food. A lot of the upper level is a cafe, which is very popular as well. And the sort of the clothes offer is actually not such a large proportion of the whole store anyway, and it's quite a small store. I think the problems Marks & Spencer are having at the moment, which are legion, and together with a lot of the other retailers, tend to be with the sort of 80,000 square foot buildings they've got in places like Scarborough. You know, this is 35,000 square feet in a key commuter town. It's the best department store in the town. It's very busy. It's also the best position. The other thing when we acquired it was we did the maths to work out what the other alternatives might be, which includes it would subdivide very easily into 4 separate high street stores of a standard size, in effect, which would then, you know, actually not only command the same rent, but potentially a higher rent than we're actually getting on that. So at an individual store level, I think we're quite positive about it anyway. And as Nigel says, we're not sure when Crossrail is going to come through because it keeps being put off, but that will turn the town into, you know, a very key prospect going forwards. But at a wider level, then, you know, there are, within any property investment portfolio, then it is good to have some retail, and everything has its ups and downs. At the moment, retail is having a down. In 3 years' time, we could be turning around and saying, well, it's really starting to perform really well. It's coming from a low base, but it's coming back. Of the retailers out there, I think M&S are probably one of the few which we can sleep at night with and not worry about too much, because they're still a massive, and you know, they're still market leading in their field. And we've seen a lot of other people struggling. But as far as the retail is concerned within the portfolio, then it is very limited, and we've turned down a lot of other opportunities we've been offered. It is fundamentally that, and in Peterborough we've got a Wagamama restaurant which is doing very well, and we've got a Starbucks which is doing very well. And, yeah, sorry, Cafe Nero, sorry. Yes, the other coffee. And so the fundamentals are very much driven by people who we believe are trading well, locations we believe are trading well, but we are, you know, what we haven't done is look at things which are apparently good value but are at the end of a high street in a poor location, or in a weak town, or anything where there's a short lease. We do have rent increases actually within the Marks & Spencer, fixed in as the years go by, it goes up every year. So rather than it going down, we're in a position there where the rent is actually contracted to increase.
Councillor Grandon and now Councillor Ayres.
Thank you.
Apologies, Councillor Grandon and then Councillor Ayres. My apologies.
Thank you. You might have answered the last bit of my previous question and what I'm about to re-ask with the last bit that you were saying. Perhaps you could explain to a novice how this works. When the retailers ask for rent renegotiation, do they ask everyone or just selected branches, let's say? And you just said you've got increases already built into the contract. Would that still hold? And if it is across the board, I don't know what your answer is going to be, how will it affect us, please?
Yeah, just going back to you on that, then what's happening is a lot of retailers are going through what they call a company voluntary arrangement, which is basically saying we are going to go bust unless we do something major. And so to pull that one off, and landlords obviously hate this, and a lot of retailers cry wolf to a degree, and there's no guarantee that they will always get away with it, but they have to be in a very poor position to start off with in order to get away with it. And we are seeing a lot of retailers in a very poor position, and so it is happening, undoubtedly. But to get there, first of all, to get that through, then they have to convince all the landlords and other people to whom they have liabilities that it is a better position to have less rent than no rent. And secondly, when they do that, then you're right, they will generally categorise their stores into, for example, a category 1, 2 and 3, where category 1 is fine, it's trading very well, they're happy with it, they know if they try anything on, the landlord's going to say, well, get lost then, we'll put somebody else in, because it's a good store, it's a great trading position, we're fine. And then there's a category 2, which are, trading okay, and if they get away with the rent, which is reduced by maybe 10-15%, then they'll be, trading positively, and that works. And the category 3, which are just rubbish, and they just should have never taken them on in the first place, and so they want to get rid of them. So it's a process which, firstly, the retailer has to convince everybody to get the vote through that actually they are about to go down. And M&S, I think, are still a long way from that. So, I'm touching wood here, but amongst the retailers, I think they are a lot stronger than most. We've got a store which we are happy is amongst the best traders, and so if anything did happen like that, and it would still be one which not only they would want, but other retailers would possibly be very keen to take on anyway. And so we are as confident as one can be that within the field of retail properties, that's one of the best ones. But we have the same. We hear the same news as you. Our research teams are looking into this consistently. We are very cautious on retail, full stop, and it looks like it will be a little torrid for the next couple of years as well. So no reason to rush back in there at the moment, and better to look at other things, is our view.
Sorry, I'm just going to add that it's worth stating that Marks and Spencer's at Brentwood invested £3 million in refurbishing that at the time that we bought it. And we know that they wouldn't necessarily spend a lot of money on something. And actually that produced the cafe and reconfigured the food orientation. So it's that much more, as Neville said, a food store than it is a clothing store. So we're quite comfortable with the asset itself. It's also underpinned by residential, because the whole of the back of the stores along that area, which backs onto a Sainsbury's supermarket, where they've been able to, they've built residential on the back. So we know it's a really strong asset.
Can I just interject here? As a lifelong retailer, watching the way the portfolio, it would seem to me, and I hope, correct me if I'm wrong, but a lot of the risk management is taken care of in the selection of the assets for the portfolio in the first place. That in fact you are diversifying your portfolio, and this is after all only 10 to 15% of that portfolio. I just don't want us to get bogged down on one sector, which is not, in fact, the major part of the story. Councillor Ayres, you had a question.
Yes, thank you. I don't know if it's the appropriate time, but can we ask what is the total cost of the portfolio holders to the council? What are we being charged?
Okay, so we're talking about the charges made against the funding. I think that comes down to Emily, really, because this is about, we actually receive an income in form of loan repayments. The company is a separate entity, so perhaps Emily could take us through how that governance arrangement works.
I have got a slide in the closed session which does deal with some of that, if you're happy to wait until we move into that session. Thank you.
Thank you very much, Emily. Councillor Caston.
Can't quite find this information. It might be given information, but these, for instance, the Go Outdoors in Harlow, the car parking area. Do we own that? Is that just? Do we just take that for given that we own the car parks outside, or is there any properties that we own where we don't own the car park?
There's a very simple answer to that question. Yes, we do own the car park as part of that ownership. There are certain situations, and retail parks are particularly one, where it may be owned in a corporate entity rather than by the actual freeholder. Not in this case. We own the whole of the site. So, which is one of the reasons why we bought it.
For every site on there that's got car parking area, we own it.
In principle, yes, i.e. the car park that's associated with the use, yes. Yeah.
I suppose it's more useful as long as our tenants have the effective use of it. I suppose that's the key to these things. Councillor Scarf.
Thank you, Chair. Well, with other councils obviously looking to invest and also investing at this time, is it becoming more difficult to acquire property? And what is your view on this going forward? I.e., are we creating perhaps a false market?
Certainly, I mean, you're aware that councils have become increasingly active in the market in recent years, and that seems to be the case going forwards. We are aware of a number of councillors who are looking to start an investment policy and emulate what you have done here, and so it's a growing trend, undoubtedly. If you look at the figures, then I mentioned earlier that over the course of last year there was 65 billion of property transacted. Of that, 3 billion was councils. So as a proportion, it's still a small proportion of the overall investment market, property investment market. So we do find on occasions that there is some competition, but when we're selling a property there might be two councils having a look at it, but at the same time that's probably within a number of 8 bidders or something of that kind. So it is fair to say that there is more council activity latterly, but as a proportion of the market it's not a major factor, and it is not sufficient to influence the market in a major way, which is probably the question you're asking.
Yes, sorry.
Can I just comment?
Mark Sargentson.
Yeah. Can I just comment, sort of by way of an additional comment in relation to the last question, which is that whilst, as has just been pointed out, there is increased activity from local authorities, and we do occasionally find ourselves, as it were, competing with one to purchase an asset, that doesn't change the criteria which we are applying in relation to yield, length of lease, quality of covenant, and if it becomes apparent that because of local authority interest, the bidding is getting a bit steamy, for want of a better expression, and the property clearly isn't going to meet our criteria, we drop out. And indeed, that's the sort of thing that has happened on a number of occasions.
Yeah, I mean, just to add on to that, I mean, I think as we said earlier, we look at probably 70 or 80 properties a year. We bid on, I'm not sure how many, might be 12 or 15 a year, but this absolutely reflects what Mark is saying. We sit there, we look and we think, right, what is this property worth? And if it gets to the stage where we think, actually, it's not worth that, it's getting too hot, we don't bid. So it's looking at, Mark's absolutely right, and Joan's saying as well, it's looking at the property fundamentals, and that's one of the jobs we do as we go through.
I calculated 8% of the properties, from the figures given, 8% were actually followed all the way through, which were less than 1 in 10, 1 in 12 in fact. Any questions? Yes, Councillor Wellham.
Thank you, Chair. A couple of questions. The first is, you were talking about break points, and there's an advantage when there's a break point in the rent. How optimistic are you that at that point you will be able to agree an increase in the rent? Because in the current climate we read a lot about rents going down rather than up. And the other question is, does your remit include selling properties?
Yes, I'll answer that question in the two parts. The first point is we monitor the market conditions very closely. We also talk to the occupiers regularly. So at least every 6 months we've been in face-to-face with the occupier. So we will understand their business, what it's generating, the direction of travel. We're also looking for them to see whether they're expanding or contracting. So we have a good understanding of individual businesses and therefore an anticipation of what may happen at the break. The only break situations we've had so far, we've had 3. 2 of the tenants have not exercised them and continue to stay in occupation. 1 has, and we've relet the building at a higher rent before they've actually left the building. So we've actually back-to-back the transaction. That was at Olympus Park in Ipswich, and it was bought for that reason, because it gives us the opportunity to move value. Some of the other assets don't have breaks at all, so you've got long-term secure income. But no, we'd monitor the break. It's, as we do with the expiry date, it's really important to understand the business that sits behind it. The second part of your question, I have now forgotten.
It's the selling point. Perhaps if I answer that. I mean, I think as I said earlier, obviously as part of the management of the portfolio that we acquired, we will be looking at assets and thinking, have we added as much value as we can to this? Is it the right time to be selling this on and reinvesting in something else where we could add more value? So it's certainly something that we will need to look as part of the management of the portfolio. I can't think of anything at the moment that we are thinking, right, we need to sell it, but it is absolutely something we should be considering and having in our minds when we're assessing the portfolio, and in possibly in 3 or 5 years' time, there may be a time when we think that's an asset where we've added value, the market's very strong, we can sell that and we can reinvest it in something which is going to give us a greater opportunity to add value moving forward.
Thank you very much. Can I just ask a question here, if I may? It is directly to the point that Chris just made, is that, am I correct in thinking that the purpose of the CIFCO operation is not, in fact, to increase capital value, it is to provide an income? And that is its entire purpose. Anything you sold, am I right, would be used to reinvest to provide an income. Is that right?
Yes, that's correct. I mean, obviously, the whole point of doing this is to provide income for the councils, and therefore, if we manage to sell something and we find we've made a profit out of it, then we will reinvest that to increase the amount of income that we can provide for the councils to provide services and everything else.
Apologies, I interrupted you.
That's fine. I was just going to say on the sales point that actually, yes, we sell and buy, but I think that's quite important because it means that if you're active in the market in both senses, then you get to learn who the competition is quite closely, and you get to learn where the market pricing is quite closely, which makes it much easier to identify the sort of prices one should be looking to pay to acquire the assets we're considering. And the other point I'd just make is that whilst Chris says, the board look at about 70 assets a year, we look at countless to refine it down to those 70. So just to make it clear, it's not just looking at 70 properties, it's looking at hundreds of properties and then refining it to 70 that fit the criteria.
Well, thank you very much. Members, any other questions before we... Yes? Councillor Mellon.
Thank you, Chair. I was reading through the papers in preparation for this, and a couple of phrases jumped out at me from the UK Economic Overview, and perhaps this is the elephant in the room, Brexit. The expectation is that an orderly exit will take place, at which I put a large exclamation mark. On the next page, amid the rising risk of a disruptive no-deal Brexit. I mean, we have a situation, I guess, where we don't know where we stand exactly. Certainly, there seems to be an expectation of exit on principle, and certainly one of the candidates for the Prime Ministership has apparently expressed his view that business doesn't matter quite so much. What are you anticipating, if that's possible to do so? What's your contingency, and what do you expect if we end up in a disorderly situation?
I'm tempted to say your guess is as good as mine, but I think the fundamentals are, or actually, fundamental to the word. If you come back to the fundamentals, where are we? We're in a situation where, unlike the sort of start of the last recession, where there was a surface of a lot of empty buildings being developed and nobody wanted to take them, and hence, the supply-demand situation was all wrong. We're in a situation where there is still a very limited supply of good quality buildings, and there is still a good occupational demand in most sectors. Now, we don't, inevitably, business will be affected. but there is an understanding that certainty and the knowledge of what is going to happen is actually going to be the key to some confidence going forwards. And we've not had that now for 18 months. We've had uncertainty and a situation where business just doesn't know where it is. And we are finding that some occupiers are holding back decisions to take space, especially those with European or US parent companies. Eventually they have to, because they have to operate their business out of somewhere. But it has slowed the process. But going forwards, then, if we know where we're going, people can make plans and proceed forwards. The fundamentals, outside of the retail sector, are still generally quite benign in terms of the supply-demand situation. And there is actually a lot of cash in the economy, a lot of money in the economy. We're seeing a lot of overseas investors still very confident in the UK. We're seeing a lot of investment coming out of the Far East and some out of Europe, but particularly South Africa and the US. And so overall, there is a confidence in the UK economy, medium to long term, I would say. The property fundamentals of supply and demand are still pretty good. And actually, if we know where we're going, then we'll be a lot happier, and occupiers will be a lot happier to make decisions which will help our market. The other thing is that we've heard Mark Carney say that in the event that we fall out of Brexit and it's a hard landing, we're not quite sure what's going on, whatever, then it is highly likely that there will be a downward adjustment to interest rates, which always helps the property market as well. So it is going to be difficult. It's a bit of a roller coaster, but we should come out of the other side without too much of a fundamental change in the market. But confidence is a key factor in the investment market, and the confidence just hasn't been there for 18 months, really, and that hopefully will come back to a degree when we know where we're going.
Could I ask a question on that point? With the covenants and the incomes and all the arrangements, the careful selection, is there any reason to suppose that they themselves would be affected by a disorderly Brexit?
No, the fundamentals are key, and no, we don't anticipate that at all. So we think the forecast for the next 4 to 5 years for the revenue stream is very robust, principally because the leases are structured to protect that income.
Any other questions from members? Any members present who not on the committee would like to ask any questions? No? Okay, I think we've had quite an extensive selection there from Emily, Chris, Neville, Nigel and Mark. So I think we'll let Emily move to the second part of the presentation. This will contain some commercially confidential information, so it's necessary for us to go to item 7, which is a resolution to exclude the public, which term I'm afraid includes the press. To consider whether, pursuant to Part 1 of Schedule 12A of the Local Government Act 1972, the public be excluded from the meeting for the business below on the grounds that if the public were present during this item, it is likely that there would be a disclosure to them of exempt information as indicated against the item. Authors are satisfied, or proposed to consider in Part 2 of the agenda, are satisfied that the public interest in maintaining the exemption outweighs the public interest in disclosing that information. Do I have a proposer for Part 2 and a seconder? So that's Councillors Muller and Councillor Osborne seconding. All those in favour of the motion? Carried. So we now move into Part 2, and I'd ask members of the public if they could leave the chamber with our apologies. Thank you very much.